Okay, this week's market outlook. So, obviously, last week we saw yields slightly cool off globally as US oil continued its descent to the downside. Macro wise, we got Canada's CPI data, which came in around consensus, which initially pushed the short end higher, which markets very quickly faded due to the softening oil prices. PMIs disappointed in both the UK and Europe for the most part, which pressured the short end, especially in Europe. Coupled with, I think it was a Tuesday, we had ECB Lagarde, who was very, well, not very dovish, but a lot more dovish than usual, which also pushed short end yields further lower in the Eurozone. Politically, the news of Starmer resigning on Monday actually benefited the sterling, as Andy Burnham being his replacement has helped cool the long end of the curve, supporting the sterling. So that was kind of the main narrative last week for the pound. It was all long end driven, as I'm sure many people know. Australia's CPI data came in slightly below consensus, however still very much above the RBA's 2 to 3% target. Following this, we then had the labour market data out of Australia, which the short end was a big fan of, pushing the AU 2-year 13 basis points higher on Friday and retracing the initial downside move derived from the Wednesday CPI reading. And then on Thursday we had US PCE, which came in soft, which is the short end in the US, which saw the short end in the US, have a slight repricing to the downside. However, US oil softening also, in my opinion, definitely over-exaggerated the move, because we'll go over it in the dollar bit, but essentially strong inflation data, strong labour market, and then you get one little slightly dovish print. It's not going to unwind the whole move. So that's my thoughts there for sure. So yeah, moving on to the calendar. So on Monday we do not have that much. We've got retail sales out of Japan, and we've got ECB President Lagarde speaking. But apart from that, there's not too much you need to be aware of. Tuesday we have the RBA meeting minutes, which will be interesting to see if RBA Governor Bullock actually continues to shift more hawkish on the more hawkish side, which I think we could actually end up seeing. We've also got unemployment data out of Japan, and then JOLTS in the US. Wednesday, we then have inflation out of Europe, which is always going to be a big print, and then we have ISM manufacturing PMIs out of the US, which is always very good, especially the ISM, because you can actually you can zoom into the report a whole load more, so you can see what's actually happening to the inflationary prices, what's happening to the stock, what's happening to employment, all that sort of stuff. And then we've also got the Fed Chair Warsh speaking, which is going to be very key on Wednesday. Thursday, we have NFP actually, which is odd because it's not on the Friday, but that's because the Friday is a bank holiday in the US. So yeah, Thursday we then have inflation out of Switzerland, unemployment in Europe, and then obviously NFP as we just mentioned. So yeah, that is what we are looking at this week, data-wise. So moving on to the macro, starting with the dollar, not much has really changed from last week. The data remains strong, rate differentials continue to be in favour of the dollar. The data this week saw a slight dovish pricing in the front end of the curve, but nothing major. That would really flip our current narrative on its head. Therefore, we remain buyers on any dips for the dollar, for now at least. And as we mentioned, NFP next week is looking to remain stable, which should support our thesis. Institutionally, JP Morgan, Credit Agricole and Bank of America are all bullish on the US dollar if we actually go and have a look here. So, well, HSBC as well actually, short GU. But JP Morgan, short Euro dollar. Credit Agricole, they are, where is it? But yeah, month-end fixing points to mild dollar buying, long on the dollar, and Bank of America, leave it here, long US dollar. So yeah, institutionally, the institutions, there's definitely a consensus for dollar longs, at least for now, until the data changes. So, moving on to the pound. We are bearish on the pound this week. Obviously, last week we had to pivot our bias on the sterling due to the reaction function from Starmer's exit as PM on Monday. Long end yields began cooling off, which obviously supported the pound throughout the week. Near the end of the week, we began to see the 30-year gilts in the UK start stabilising, which indicated that short-end gilts should take control for the week ahead, and that essentially the political risk premium has now been priced in to the pound for now. So obviously now we're going to see the short end kind of take control, and short end gilts remain to point to the downside. Softening US oil prices, a weak labour market, and growth data with inflation seemingly peaking should lead to further dovish repricing in the short end. So that's kind of where we're at on the pound. Institutionally, JP Morgan and UBS are bullish on the pound, whereas HSBC and UOB are both bearish on the pound. So kind of take it as you will. I think the thing is with these institutions that were bullish last week, like JP Morgan and UBS, they kind of pivoted their bias because of the political developments, of course. But now that's kind of seemingly priced in, or at least in my opinion, it's a lot more priced in. We'll have to see what they say on the Monday. So the Monday is going to be very key to see what JP Morgan come out with regarding the pound, to see if they've pivoted their bias again now. So yeah, bearish on the pound. Now the euro. So as it has been, we're still dependent on the cross. Last week the euro took a pretty decent hit due to weak PMI data, indicating weak growth within Germany and France specifically. We also obviously have US oil prices continuing to move to the downside, which is mounting pressure on Europe's short end and leading to the market's unwinding rate hike prospects most aggressively as well out of anyone out of G8. So the softening oil prices are having the biggest impact on, New Zealand dollar and the euro are the two currencies that are getting hit the most from these softening prices. I like Euro Pound, Euro NZD and Euro Swiss upside, whilst Euro Dollar downside makes sense. And then institutionally, Morgan Stanley are bearish on the euro against the dollar. And actually, let's have a look at what the asset managers have done. So last week, you can see obviously asset managers are still overwhelmingly long on the euro, but they trimmed some of their positions. This current environment is everything's changing. Every week it's changing, so the CFTC data is not as relevant, I'll say, and the institutional documents and research is going to be way more powerful at the moment. So that's the euro. CAD, we are neutral on the CAD at the moment. It's being mainly driven by the US dollar. And macro-wise, Canada is in a weak-ish position. You've got rate differentials continuing to soften, and as previously mentioned, softening US oil prices is also putting the CAD on the back foot. But for now, it's being driven by the US dollar, so we're just going to have to play strength until we see a pivot in what's actually driving the CAD. JP Morgan institutionally are bearish on the CAD as well, and if you look at the positioning here, so pretty neutral. Asset managers last week, they kept their positions like that. Leverage funds actually increased their shorts. So yeah, that's kind of where we're at there. The Australian dollar. So we are currently neutral on the Australian dollar. Equities are continuing to struggle, even with the US 2s taking a slight hit on Thursday. Commodities, especially gold and copper, remain pressured due to elevated rates in the US, which is also dragging on the Chinese yuan. Data-wise, the macro does remain strong in Australia. Last week's CPI and labour market data resulted in the short end of the curve, ending the week retracing the softer CPI print. However, nothing game-changing for the Australian dollar at the moment, in our opinion. Institutionally, JP Morgan are bullish, whilst ANZ are bearish. So yeah, it's safe to say that some of the institutions are currently quite divided on the Australian dollar. But I'd say if you can track what's happening with the dollar and track what's happening with equities, you'll be able to notice, and yields, you'll be able to it's quite a clear conviction pair for like AUD dollar downside, for instance. Moving on to the New Zealand dollar. So we are bearish on the New Zealand dollar this week. The New Zealand 2-year, as we kind of mentioned last week, has been tracking softer US oil prices very closely. As a result, New Zealand's short end has continued to drift lower. I also think other factors like dollar strength has reduced support for China-linked currencies. obviously given New Zealand's close economic ties to China. So yeah, essentially the combination of softer oil prices, softening inflation expectations, weak China proxies continues to point to a weaker outlook for the New Zealand dollar and its short end. Institutionally, Citibank, JP Morgan, they're both short on the New Zealand dollar at the moment. I mean, if we look here, yeah, we can see asset managers are also increasing their shorts, and so are leverage funds, but leverage funds are kind of neutral. Now the yen. The yen is a very interesting one because intervention is definitely pending, in my opinion. I mean, I was reading a document. Oh, yeah, here. You can see here in the insights. Citibank, they are expecting intervention at $160 to $162 on dollar yen. So yeah, and where are we at right now? We're like around we're in like the 161 territory for sure. So I think this week we could see intervention take place. I mean, if you even look at like speculative short yen positioning, it's like we're reaching extremely low levels, well, high levels for shorts. So I think they're going to have to pull the trigger at one point, which is why I'm leaving it. And to be honest, if you're a good swing position, could be just getting in a short now with your stop at around 163, 164. That's kind of where I see this moving. So yeah, I'm leaving the yen for the week ahead because you can just get caught out by the intervention. Now, finally, the Swiss franc. So yeah, we're bearish on the Swiss franc. Although US yields dipped on Friday, I do expect the US 2-year to remain somewhat elevated due to strong US data and softer US oil prices being priced in, which is obviously going to keep pressure on the commodity currencies, specifically the Swiss franc, which has such a very tight link to gold. High yields also continue to make the Swiss franc a great funding currency, which will also drag on the Swiss franc. And then institutionally, the Bank of America, Citibank and JP Morgan are all short on the Swiss franc. So yeah, that's the macro for this week. Moving on to the technicals. So starting with the US dollar, we remain bullish obviously, and to be honest, this level here, the 101, we had a 101.6, we had a lovely bounce off it, and to be honest, I expect us to move higher. I mean, targets wise, we've got highs here. These highs I think most likely will get taken. So yeah. Dollar Swiss. Let me move this. Dollar Swiss, I think we could either break above and come into this level here, or this level down here, which is it's the point. It's not really a clean level, but this is what I'll be looking at if we do come any lower, which I think is unlikely. Actually, 6 hour time, I don't think it's unlikely. We could come down here, for sure. So, yeah. Dollar CAD, exact same thesis. We had a bounce off this level here, but it's clearly not being respected too much. So I think this level here is going to be the next big one, the 1415. NZD dollar, we've got monthly lows to target, and I think this level here looks nice. GU, similar thing. Wanted to get into this on the Friday, in fact, but it just never tagged me in. We've just taken out the weekly highs on GA, so I think end of month flows as well could see this shift. So I think the 192 for shorts is extremely appealing. I'll definitely be getting in here if we do end up breaking higher. And then tactically, if we don't before we do, this level looks decent, but I don't think I'll get in here. EU, exact same thing as the DXY, expecting it to go lower, so take out this weekly low. So maybe a retracement into this demand zone here, the 114 seems kind of ideal. See if we get a gap off the open. Let me just get this level down. That. So yeah, something like the 114. Euro NZD, this is definitely lower time frame because I mean the trend is just so overwhelmingly clear. You've got rate differentials supporting it, oil supporting it, equity supporting it. So it's definitely been one of the more highest conviction plays at the moment for sure. So yeah, something like this. The reason it's here, I would like to see Asia low get taken. not Asia low, I'm talking rubbish. New York low, sorry. And then here, I'd like to see Asia low get taken here, sorry, that's what I want about. Euro pound, I think we're coming near the end of the pound strength from the long end. So I think we'll either get a bounce from this level here, if not, definitely this level here. That's what I'm looking at. Euro Swiss, noticing these levels here. This level looks really nice, so does this level. Euro AUD, similar thesis. Asia low on it. This is what I was talking about. Asia low gets taken out there. Probably get in at the 1645, just above it. Euro CAD, similar thesis. This level here. CAD Swiss. This level looks nice. And then I believe AED NZD is the last one. Yeah, AED NZD. I think ideally we could get a bounce off this level here. We could see a bounce off this demand, but I think this will be much cleaner. So yeah, something like that. And I believe that is the technicals. Maybe gold. Yeah, gold are in a nice level. I didn't get in this, but I think we're in a nice level for continuation to the downside. So yeah, that is those are all the technicals for the week ahead, and I'll catch you in the next outlook.